The Forex market, a vast and dynamic ocean of currency exchange, presents immense opportunities for profit. Traders worldwide, armed with charts and strategies, dive into this sea of possibilities, hoping to ride the waves of price fluctuations to financial success. Yet, like any ocean voyage, navigating the Forex market requires careful planning and execution, especially when it comes to managing risk effectively. Just as a ship needs a compass and a skilled captain to avoid storms and reefs, Forex traders need risk management to protect their capital and ensure long-term success. Without it, even the most promising trades can turn into devastating losses, leaving traders stranded and discouraged. This essay will serve as your guide to understanding and implementing effective risk management strategies in your Forex trading journey. From setting your risk tolerance to mastering your emotions, we'll explore the essential tools and techniques to help you navigate the Forex market with confidence and prudence. Remember, in the exciting but unpredictable world of Forex, risk management is not just an option, it's your lifeline to staying afloat and reaching your financial destination successfully. Imagine two Forex traders, Alex and Ben, both starting with $5,000 in their trading accounts. They are both eager and ambitious, ready to dive into the world of Forex trading with high hopes and dreams of financial success. However, their approaches to trading couldn't be more different. Alex, a firm believer in risk management, only risks 1% of his capital on each trade. He meticulously plans his trades, analyzing the market conditions and setting realistic goals. Alex understands that the Forex market can be unpredictable, and he prepares himself for any outcome. Using stop-loss orders to limit potential losses, Alex ensures that he never loses more than he can afford. This disciplined approach allows him to stay in the game longer, giving him more opportunities to learn and grow as a trader. Ben, on the other hand, is driven by excitement and often risks 10% or more of his capital on trades. He is constantly chasing the thrill of quick and substantial gains, believing that high risk will lead to high rewards. Ben's approach is more impulsive, and he often makes decisions based on gut feelings rather than careful analysis. Hoping for quick and substantial gains, Ben frequently finds himself in volatile market situations. He believes that taking bigger risks will help him achieve his financial goals faster, but he often overlooks the potential downsides of such an approach. One week, both Alex and Ben encounter a series of losing trades. The market takes an unexpected turn, and their strategies are put to the test. This is a critical moment for both traders, as it will reveal the strengths and weaknesses of their respective approaches. Alex, with his 1% risk management strategy, experiences minor setbacks, losing only a small portion of his capital. His careful planning and disciplined approach help him weather the storm, and he remains confident in his long-term strategy. Ben, however, suffers significant losses due to his high-risk approach. The large percentage of his capital that he risks on each trade means that the losing streak hits him hard, and his account balance takes a severe hit. The stress and frustration begin to take a toll on him. Despite these losses, Alex remains calm and sticks to his risk management plan. He understands that losing is part of trading and that protecting his capital is crucial for long-term success. His focus is on the bigger picture, and he knows that his disciplined approach will pay off in the end. He understands that losing is part of trading and that protecting his capital is crucial for long-term success. Alex's ability to stay composed and follow his plan, even in the face of losses, is a testament to his understanding of the Forex market and his commitment to his strategy. Ben, overwhelmed by his losses, starts making impulsive decisions, increasing his risk even further in an attempt to recover quickly. His desperation to make up for his losses leads him to take even bigger risks, which only exacerbates his situation. This scenario highlights the critical difference between trading with and without proper risk management. While Alex's disciplined approach allows him to manage his losses and stay in the game, Ben's impulsive decisions and high-risk strategy lead to significant setbacks. While both traders face similar market conditions, their outcomes were vastly different due to their approach to risk. Alex's careful planning and risk management strategy helped him minimize his losses, while Ben's high-risk approach resulted in substantial financial setbacks. This tale of two traders underscores the importance of risk management in Forex trading. It serves as a powerful reminder that success in trading is not just about making profits, but also about managing losses and protecting your capital. It's not about avoiding losses altogether, but minimizing their impact and protecting your capital for future opportunities. By adopting a disciplined approach to risk management, traders can navigate the unpredictable Forex market with greater confidence and resilience, ultimately achieving long-term success. Before you even place your first trade, it's crucial to determine your risk tolerance. This is the cornerstone of any successful trading strategy and cannot be overlooked. Understanding your risk tolerance means knowing how much potential loss you can handle both financially and emotionally. This refers to the amount of potential loss you're comfortable with on a single trade and your overall trading account. It's not just about the numbers, it's about your peace of mind and your ability to stick to your trading plan even when things don't go as expected. Start by honestly assessing your financial situation. Take a close look at your income, expenses, savings, and any other investments you might have. This will give you a clear picture of how much you can afford to allocate to trading without jeopardizing your financial stability. Ask yourself, how much money can I afford to lose without significantly impacting my financial well-being? This is a critical question because trading should never put you in a position where you're risking money that you need for essential expenses like rent, bills, or groceries. What level of drawdown or percentage decline in your trading account am I emotionally comfortable with? Drawdowns are inevitable in trading, and understanding your emotional response to them is key to maintaining discipline and avoiding panic-driven decisions. Remember, never trade with money you can't afford to lose. This is a fundamental rule that protects you from financial distress and helps you maintain a healthy trading mindset. Trading with money you can't afford to lose can lead to stress, poor decision-making, and ultimately, significant financial loss. Forex trading involves risk, and it's essential to approach it with a clear understanding of your financial limits. Knowing your limits helps you set realistic expectations and prevents you from taking on more risk than you can handle. Once you have a clear picture of your financial capacity for risk, you can establish a risk percentage per trade. This is a predetermined amount of your trading capital that you're willing to risk on any single trade, which helps you manage your overall risk exposure. A common starting point for many traders is 1% of their trading capital. This means that if a trade goes against you, the maximum loss you would incur is 1% of your total trading account, which helps in preserving your capital over the long term. For example, if you have $5,000 in your trading account, your risk per trade would be $50, which is 1% of $5,000. This approach ensures that no single trade can significantly impact your overall trading account. Defining your risk tolerance is a personal decision based on your financial circumstances, investment goals, and risk appetite. It's important to revisit and reassess your risk tolerance regularly, especially as your financial situation and trading experience evolve. It's not about being right or wrong, but finding the level of risk that allows you to trade confidently and responsibly. By understanding and respecting your risk tolerance, you can create a solid foundation for your trading journey, enabling you to make informed decisions and stay committed to your trading plan. In the world of Forex trading, emotions can often cloud judgment, leading to impulsive decisions and potential losses. The fast-paced nature of the Forex market, with its constant fluctuations and volatility, can be overwhelming for even the most experienced traders. The pressure to make quick decisions can result in mistakes that could have been avoided with a more structured approach. That's where stop-loss and take-profit orders come in as your automated trading guardians, helping you manage risk and secure profits without succumbing to emotional biases. These tools are essential for maintaining a disciplined trading strategy, ensuring that your trades are executed according to your plan, rather than being influenced by the heat of the moment. A stop-loss order is an instruction you set in your trading platform to automatically exit a trade if the price moves against you by a predetermined amount. This is particularly useful in a market as unpredictable as Forex, where prices can change rapidly and without warning. By setting a stop-loss order, you can protect your capital and prevent a small loss from turning into a significant one. This order acts as a safety net, limiting your potential loss on a trade. It allows you to define the maximum amount you are willing to lose on a particular trade, giving you peace of mind and allowing you to focus on other opportunities in the market. Without a stop-loss order, you might find yourself holding onto a losing position for too long, hoping for a reversal that may never come. On the other hand, a take-profit order is designed to automatically close your trade when the price reaches a specific profit target. This ensures that you lock in your profits and don't let greed or fear influence your decision-making. By setting a take-profit order, you can secure your gains and avoid the temptation to hold out for an even higher price, which could result in losing the profits you've already made. This ensures that you lock in your profits and don't let greed or fear influence your decision-making. It's easy to get caught up in the excitement of a winning trade and hold on for too long, only to see the market turn against you. A take-profit order helps you stick to your trading plan and ensures that you walk away with the profits you aim for. For instance, let's say you're buying the EUR-USD currency pair at 1.1000 and set a stop-loss order at 1.0950, risking 50 pips. This means that if the price drops to 1.0950, your trade will automatically close, limiting your loss to 50 pips. This predefined risk level allows you to trade with confidence, knowing that your potential loss is controlled. You also set a take profit order at 1.1100, aiming for a 100 pip profit. If the price moves in your favor and reaches this level, your trade will automatically close, securing your profit. This approach helps you to stay disciplined and stick to your trading plan, rather than getting caught up in the emotions of the market. If the price moves in your favor and reaches 1.1100, your take profit order will automatically close the trade, securing your 100 pip profit. This automated approach ensures that you don't miss out on your profit target, even if you're not actively monitoring the market at that moment. Conversely, if the price drops to 1.0950, your stop loss order will trigger, limiting your loss to 50 pips. This automatic execution helps you to avoid the emotional stress of deciding whether to hold on to a losing trade or cut your losses. It enforces a disciplined approach to trading, which is crucial for long-term success in the Forex market. Using stop loss and take profit orders is a fundamental aspect of risk management, providing you with a disciplined approach to exiting trades based on predetermined parameters rather than emotional impulses. These tools are not just for beginners. Even seasoned traders rely on them to maintain consistency and protect their capital. By incorporating stop loss and take profit orders into your trading strategy, you can navigate the Forex market with greater confidence and control, ultimately enhancing your trading performance and achieving your financial goals.